Do you think that the efforts made towards kickstarting private investment, Mr. Wadhwa, have been incremental, that they could have done so much more, but they didn't? Or the other way to look at it is, for instance, by saying that we will capitalize PSU banks by 70,000 crores, we'll throw a lifeline to NBFCs to help them in this, sort of beleaguered state that they are in. We'll consider, sovereign borrowings in foreign currency. These are all efforts to kickstart, A, the credit cycle within India itself by recapitalizing public sector banks, B, by moving some of your government borrowing offshore. You're maybe choosing not to crowd out private sort of capital raise here in India. Are these enough sort of steps to help push investment in any big fashion?
I would say they are very good starting points. Okay. They are obviously not enough. I mean, a lot more needs to get done as time lapses, but there's certainly very, very good starting point. 70,000 crores in the banking sector, and even if you say that half of it is used to provide for NPAs, 35,000 crores of additional capital can result in a serious uptake of credit by the domestic banks by borrowing in the global market and making more money available in India to Indian corporates. Government is trying to encourage creation of a debt capital market, and I would say these are all very important first steps in the growth of that in that segment.
Okay, great. Now we have Mr. Seshagiri Rao who's joined us. Mr. Rao, we've been talking about whether this budget has done enough to really help push or boost growth from the point of view of both private investment and private consumption. And at the end of the day today, do you feel more encouraged that you might in fact see a pickup, let's say in the next few months, on account of some of the articulations of the finance minister, on account of some of the measures that we've just been discussing? Or do you think it's all still incremental and peripheral?
No, there is a good budget from that point of view. The major problem today is the liquidity or financing to either for consumption or investments. So those issues I think they try to address with a very clear headline number of $5 trillion economy by 2024-25. So whatever they have done in the case of NBFC and also deepening the bond markets and also allowing FIIs or FPIs to come into the market and permitting them to transfer their securities within the lock-in period to the domestic institutions. I think these are all the great steps which will definitely improve the liquidity and the lending in the market. So which should stimulate, in my view, both consumption and also the investments. Coupled with the government expenditure, which is including the extra budgetary support, is over 8 lakh crores of rupees. Coupled with again the state's expenditure, I think this engine should bring back some spur in the investments cycle and also consumption.
But Mr. Rao, didn't you think that this was a budget of many small, tiny parts? No one big sort of overarching vision that unified it? Or am I reading that wrongly?
I don't think so. The overarching already has given the macro headline number, that is a 5 trillion economy. So for doing that, what is required to be done, I think the vision is very clear. So whatever short-term problems which the economy is suffering today, is that it is not actually the demand is completely disappeared. The cause of slowing down in the demand or investments is because of banks are not able to lend, NBFC there are problems, and the foreign investors are not able to come into India. I think those issues are adequately addressed in my view.
I can bring you here in Mr. Shankar Raman. Do you think that there could have been more that could have been done on the NBFC front?
See, actually the problem with NBFCs are multifold. One is, I think the sector is under a lot of cloud. Some of it proven, a lot of it out of fear of what markets may not know. The drying out of the liquidity and restricted access that they have, coupled with some of the NBFCs who are part of larger groups, in fact have another problem of having to comply with the Basel norm about maximum group exposure, which has been brought down in the name of risk management and prudence significantly. It used to be 40% of Tier 1 and Tier 2 capital. It has become 25% of Tier 1 capital. So large groups who have the pedigree to support the financial services business are constrained because they have to allocate resources between various engines of growth that they oversee. In addition to that, you have the market fears about NBFC's asset quality being under question, and a lot of this has also got to do with the suspect asset valuation and the underlying quality of assets per se. For example, the real estate sectors has caused stress, the loans against shares portfolio, the construction financing. Some of these, the sectors are under stress. So consequently, I think it was a bit too much to expect the budget to address all of these sectorial business related problems. But what it gives a window, it actually opens up a window by addressing and recognizing that liquidity is indeed a constraint and something needs to be done, and by allowing FPI, FI inflows to participate into the instruments of NBFCs, the core investment company and deposit taking NBFC is a good step forward. But I don't think this is sufficient to solve all the problem. Just a crack that has been opened up, and a lot needs to be done between the regulator and the regulated to A, understand the problem in common, and B, try to solve it. So a lot of work needs to be done, Menaka, outside of the budget, but the budget does recognize this problem.